Are we back to soft landing talk?
Well, I think for many of us, we didn't leave that forecast too far. I think the consensus among many was that the kind of stall in disinflation in Q1 of this year looked like it was probably anomalous factors, some residual seasonality, and that the prints for April, whether it's CPI or PCE, have been more on track, as you just said. That's very welcome news, but it's just 1 month. So both we and certainly central banks, including the one you were just talking with, need more confidence in that forecast. But the forces of disinflation that helped us so much in the second half of this year, I think they're still in place.
Well, it becomes a question, Mr. Chairman, of what needs to happen for that disinflation to continue. The fact that we got cooler data today, coupled with a slowdown in consumer spending, is that actually a sign that further progress on inflation is going to have to mean a weaker U.S. consumer?
Well, it's really an important point because obviously so far what we call the sacrifice ratio, meaning how much demand we've had to give up to sacrifice to get the disinflation we've seen, has been about zero. We've had, I looked this morning at the report, 4.4 percentage points of disinflation in the PCE, while the unemployment rate is virtually unchanged, below 4% for over 2 years, and consumer spending is actually up over that period. So, you know, that tells you that much of the progress has been made on the economy supply side. It looks to me like the demand side is still quite intact, where we have a solid labor market supporting consumer spending. But I take your point regarding April. One thing I'll say about that, which I think has been somewhat underappreciated today, if you simply plot out real consumer spending, it's been growing above trend for a while. It came up a little bit in your conversation about the U.S. as a strong growth outlier that you had with the Spanish economic minister. The fact that we've been consistently above trend means we have a little wiggle room there, and so I'm confident that we should be able to continue to push ahead.
The sacrifice ratio sounds like a prog rock band, Jared. Where will the sacrifice ratio be when we hit 2%?
Well, it's just about one of the most important numbers one can talk about right now, because lots of economists assured us that the only way to get this much disinflation that we've seen would be through much higher unemployment, much more demand destruction, in the spirit of the question you just asked me. Thus far, that hasn't been the case, and that's certainly been the president's goal. His instructions to his economics team is we're not going to get inflation back to where it needs to be on the backs of working people. We need to maintain a job market that's generating real wage gains. And that's, of course, what we've been seeing now for well over a year, wages beating prices. That helps to feed back into consumer spending, and it's one of the reasons why this recovery, this expansion, has been continuously and I think reliably quite strong.
Well, you talk about wage data, Jared. We'll get more of it next Friday when we get the jobs report. Right now, the non-farm payrolls estimate is 190,000. You're on with us frequently on Jobs Day talking about a labor market that is returning more towards normal, towards trend. Perhaps that kind of figure wouldn't scare you. But is there a number that would frighten you, that something is starting to break? Where do jobs need to come in for you to still feel comfortable with this labor market?
So the number that comes to mind when we're trying to contemplate that question is the break-even rate or break-even number. And that's the number of jobs that you need to keep the unemployment rate from rising given the labor force. Now, we've had some really nice results in the labor force. Again, this is a statistic that's historical and I think somewhat underappreciated. We have women's labor force participation and employment rate, both of those important kind of demand side indicators, at their historically highest level they've been since these data began to be tracked in 1948. As the labor force has expanded, we've been able to have higher break-even numbers, so we can get numbers that are 190, 200, north of 200, and see unemployment kind of hold steady. That suggests the break-even rate is a little higher than folks thought. So look, I think the key point here, kind of wrapping a lot of what we've been talking together, especially on the inflation side, is that it looks to me like supply and demand are much better aligned in the labor market. And that alignment has not come through job loss. So we haven't seen unemployment go up very much. It's come through lower vacancies. Vacancies have come down. And that's a great way to, if you have to align supply and demand in the labor market, that's the way you want to do it because it doesn't fall on the backs of working people.
A week from today, Jared, we'll be talking about the latest jobs report. Will that data confirm some of the ideas that we're talking about?
Well, look, I mean, forecasting the jobs report even a week out is a very tough thing to do. I guess the way I would phrase it, and consistent with our conversation so far, is we have an economy that has some, I think, quite positive momentum. Yes, we've seen some slowing, whether it's GDP, whether it's the number of job growth, but that slowing is down to rates that I would call more steady, more stable, as the economy just normalizes after coming out of the pandemic. In a 70% consumer spending economy, if you have a really healthy labor market, which ours has been for over 2 years, and you have inflation coming down at a decent clip this morning, inflation down 60% off of its peak, that translates into real earnings, feeds back into consumer spending. And, you know, let's take a close shave with Occam's razor, if we will, and just kind of call that a healthy, kind of perpetual motion economy that's been reliably delivering for working households for a while now. Now, look, I want to be clear. We've got a lot more work to do on the price side. Prices are still too high, and we have an aggressive cost-cutting agenda that we're going to continue to push. But the macroeconomy has been delivering solid numbers.